if the system requires interest rates, positive interest rates, fair interest rates, for want of better word, if it requires a fair rate of interest to operate, and that rate is distorted for a prolonged period of time, then the system starts to fail. Then you get younger people growing up, and they're thinking, we have a society which is highly unequal. And this is something we haven't talked about, but when the interest rates are low, the haves, people who already own assets, people who own houses, people who own the stocks, whatever, they do well because those prices get inflated. But people who don't have any assets suffer. They suffer in particular because the less well off you are, the more money you're likely to hold in cash, in deposit on the bank, in part because, well, not just because you don't have access to venture capital or private equity or hedge funds, whatever, and also you need, if you're going to lose your job,
it's your emergency fund. It's you need the money.
You need some precautionary savings. Those precautionary savings will be or should be in cash.
Yeah.
And so you are targeting the ultra low rates target inadvertently the least well-off savers in an economy. And because the interest rate is the rate at which savings accumulate, then you're also making it harder to retire, harder to buy a house. If what I'm saying about productivity growth and income growth is true, you also mean that the person's not actually going to see such strong real income growth going forward. So what are they going to think? They're going to think, hey, I don't like this system. I'm going to be a communist or whatever. I mean, little do they know that actually one of the reasons that the Soviet Union fell is that it didn't have interest rates to determine the allocation of capital. And the allocation of capital was so absolutely appalling in the Soviet Union that it collapsed. But you can I completely understand, I think, why people would be aggrieved by a system that is beginning to fail. And I don't think it's generally, this point I'm making that this distortion of the interest rates is in part responsible for failure. I don't think that's generally recognized. In part because there's always been the main narrative on interest for 5 millennia has been that charging of interest is unfair and it's exploitative.
Shylock, is it?
I mean, you go. I mean, it's true that in the ancient world, people and in the ancient world and in the modern world, particularly in poor rural economies, you will get exploitative usurers who are driving people into debt bondage, who are taking their property and so on and so forth. And that's absolutely, and they still do, and that's also true of payday lenders and
loan sharks, payday loans.
Archbishop of Canterbury did his war on Wonga.
I worked in the debt management industry at the time that payday loans were prevalent. And I think the bad thing about them was that their business model relied on people defaulting. Mm-hmm. So they didn't want you to pay the loan back. And they made it very easy for you to not roll it over for 50 quid. Yeah. And if you fail, it's 5 times the loan instantly. It was predatory in that sense.
Yeah,
like you say.
What we call usurers.
Yeah.
And actually, this is another interesting thing, if you remember that I point out in the book, is that these ultra-low rates were meant to, after the financial crisis, if you ask, the central bank, we're, intended to, reduce unemployment, to as Janet Yellen, who was chair of the Federal Reserve, now US Treasury Secretary, says, we're trying to help Main Street. But in fact, after the financial crisis, the banks all tightened their lending standards. So, subprime was out.
They gave birth to that industry.
Yeah, but also the rates charged.
Yeah.
But credit card rates didn't come down. I think they still just chug along at 25%. So in that sense, they, as you say, the ultra low rates fed loan sharking, and actually meant if you were poor and had a low credit score, you didn't benefit at all. If you, as I say, and I will repeat, if you were very rich, you could go and invest in make leverage type of investments and make a huge amount of money in private equity in particular. I mean, it's
property even, like for the more normal person, they could leverage a portfolio quite aggressively, whereas you're saying that people with no money were exposed to really high interest rates in a really low rate environment, and that bred more inequality essentially.
That's what I would argue, that very high rates, so these usurious rates we're talking about, payday lending, that breeds inequality. So you've got some bunch of scoundrels making a lot of money from these payday loans. So that's what, and they're sucking money and capital from the borrower. So that's an inequality. But then there's this other inequality, which is relatively new and it's a type of inequality that happens in a modern financialized economy, which is what we've talked about, the haves having more when interest rates are low and the have-nots having less.
That was a clip from our full-length interview with Edward Chancellor about the impact of ultra-low interest rates. You can watch the full episode right here.